Hello, everyone, and thank you for joining us. My name is Daniela Martinez, and I am the recent alumni and student program coordinator at the University of Colorado Boulder's Leeds School of Business. Welcome to our Just-in-Time Leeds webinar. We are so excited to be here today. Leeds is a top business school offering undergraduate, MBA, executive MBA, MS, and PhD programs, and has an alumni network of over 41,000 strong living and working around the world. For today's Leeds Professional Development webinar, we're excited to welcome Sanjai Bhagat, who is here presenting Silicon Valley Bank Demise, Causes and the Path Forward. A few housekeeping items before we begin. First, if you have any questions now or during the presentation that you would like to ask Sanjai, please submit a question through the Q&A interface. We will monitor questions as they are submitted, and Sanjai will respond to them at the end of the presentation. As a reminder, for optimum audio quality, we do have everyone on mute except for myself and our speaker. If you experience any technical difficulties during the webinar, please notify us through the chat interface, and one of our support specialists will touch base. Lastly, a link to access the webinar recording will be sent to all registrants tomorrow, along with a survey link and supplementary resources from today's presentation. Now, I am excited to introduce today's speaker. Professor Bhagat's critically acclaimed book, Financial Crisis, Corporate Governance and Bank Capital, published by the Cambridge University Press, provides a detailed analysis of the 2008 banking crisis. His analysis and recommendations on how to avoid future bank crises have been considered by national regulators, such as the SEC, FDIC, and the Federal Reserve, along with international regulators, the Bank of International Settlements, Basel, Switzerland, and bank directors. Recently, the Washington Post has highlighted Professor Bhagat's analysis of the Silicon Valley bank debacle. Welcome, Sanjai, and thank you so much for being here. I'm going to hand over the webinar controls to you now.
Thank you, Daniela, and good afternoon, everybody, and a special good afternoon to all the CU buffs out there. So a well-known saying is that politicians, like generals, tend to fight the last war. Similarly, bank regulators tend to fight the last banking crisis. So what are we talking about? Well, in 2008, we had our last banking crisis that led to a financial crisis in our economy. The core, one of the core issues that led to that banking crisis had to do with the difficult to value assets that the largest banks were holding. So the largest banks were holding several $100 billion each worth of these very difficult to value assets that had to do with mortgage-backed bonds. And so that was one of the issues that came up a lot. And I have a detailed analysis of that in my book that the organizers talked about. This more recent crisis that started off with the Silicon Valley Bank in March of this year, there sort of the problem on the surface appears to be a duration mismatch. Essentially, the banks, Silicon Valley Bank, and now as it turns out also First Republic and Signature, they were accepting large amounts of demand deposits. Demand deposits are just that. The customer that deposited some cash, money in their accounts in your bank, they can demand that the very next day. So these banks were getting a lot of demand deposits. And 3-4 years back, when the interest rates were low, there wasn't a problem. They would just keep those demand deposits more or less in-house. But as the interest rates started to go up, what these banks thought they should be doing is instead of keeping mostly the demand deposits in-house, they would invest in longer-term treasury bonds and treasury bills, which were now paying significantly higher interest rates than what they were just 3-4 years back. So when these banks started to hold these longer-term bonds, as the interest rates started to go up, the value of these bonds started to go down. That sort of is a standard finance 101 thing. There is nothing very mysterious about that. And so this was the duration mismatch, that the liabilities, the bank deposits that the banks were getting, were very short term, essentially overnight or even less. And the assets that the bank bought with it were longer term treasury bills, which nominally are risk free. And then also they invested that in some mortgage bonds. So on the face of it, these two crises look like they had somewhat different origins. What we are concerned with is in understanding the common denominators, if you will, of these banking crises. We just talked about the last two, but I've also studied and looked at the earlier banking crises. And what this webinar is focused on is in how do we prevent the next banking crisis. So obviously we need to learn from what happened, but then the focus is, especially in a business school forum, how do we prevent the next crisis? And what we are recommending is a two-pronged approach. The first prong has to do with bank CEO and bank board directors' incentive compensation. Essentially, we are recommending that the CEOs and the bank directors' incentive compensation can only consist of restricted stock and restricted stock options. And these restrictions are such that they cannot sell the shares or exercise the option for at least 6 to 12 months after their last day in office or the last board meeting. The other prong has to do with the bank equity capital, essentially the bank equity capital ratio. What we are recommending is that the bank's equity to total assets should be at least 20%. It should even be higher than that. Most bank regulation and most bank reforms are focused on some version of bank capital. There's almost nobody, or there are almost no observers in this bank crisis, bank reform debate that are talking about the first issue that has to do with the incentives of the bank CEOs, the bank C-suite managers, and the bank directors. So one of the things we are trying to focus on is by simply looking at bank capital, bank equity capital, the bank regulators, the bank directors are missing out on a very important way that has been developed extensively in corporate finance, where the shareholders devise incentive compatible contracts, incentive compensation contracts for the CEOs that has allowed US corporations to create vast amounts of wealth in the country and large number of jobs. So this incentive compensation is at the core of what distinguishes our recommendation from others. So along with the incentive compensation, we also bring in the bank capital, and we are recommending a fairly high level of bank capital ratio. Because as we'll see later, most bank regulators and indeed the banks that we have, including Silicon Valley Bank that went belly up, and then more recently First Republic, their bank equity to total assets was a lot less than 20%. And some of the banks, the regional banks that are doing fine, have a much higher equity capital ratio. So we will get to that. All right, so here's the story that bank CEOs, some bank observers, and the allies of bank CEOs like to tell as to what happened in 2008, and indeed what might have happened, or what happened with regard to Silicon Valley Bank and First Republic and Signature Bank. And the story is that, look, these bank CEOs and the bank executives are serious-minded, hardworking professionals, and they are working faithfully in the interests of the long-term shareholders. And sometimes, unforeseen things happen, meaning things that cannot be predicted, and that may cause poor performance of the bank, and that may indeed lead to a banking crisis that can also be very significant and lead to a financial crisis in the country. So that's the sort of the good part of the story. So if you believe this good story that, whatever happened unexpectedly. So back in 2008, the bank CEOs, were buying all these difficult to value assets, and then somehow in 2008, they just realized that, oh my goodness, these assets are difficult to value. And the same in this year, earlier with Silicon Valley Bank, they just realized that, look, we have a duration mismatch. If our demand depositors, our customers that deposited millions of dollars, in some cases hundreds of millions of dollars in our bank, if they come and ask for their money back, we couldn't give the money back to all of them, because they've invested the money in long-term bonds whose value has fallen tremendously because the interest rates have gone up in the meantime. So if you believe this story, then basically if this risk that has come was unforeseen, that means nobody knew about this risk, and even the CEO did not know about this risk. So with regard to their trading, essentially, or the sales of the stock of the bank, you should see normal CEO stock trading before this banking crisis. So in this case, in the case of the 2008 crisis, if you looked at the period, say from 2000 to 2008 or 2004 to 2008, in this most recent crisis, if we were to look at the bank CEO stock sales, say from 2021 through February of 2023, the amount of stock sales that the bank CEO is engaged in should be some normal level. There should not be any abnormal high sales. That's what comes out of this good part of the story, that these were hardworking folks and something unexpected happened. You really can't blame them. One important aspect of this, the good part of the story is, look, since nobody is to blame here, and essentially at the end of the day, the US taxpayers have to bail out these banks. So basically, there's nothing to be done here. And US taxpayers better be prepared for the next bailout, whenever that happens, to fork out more of your hard-earned taxpayer dollars to bail out the next set of banks. So that's other thing in the background. If you believe this good story, that this is what really is going on. The bad and the ugly part of the story is what we refer to as the reason why you see these banking crises is because the incentives that are generated by these executive compensation programs, essentially, these incentives are such, and we are talking about executives, the CEO, just the top level executive in the bank. So the incentives are such that they get the bank managers to engage in high risk-taking investment strategies, trading strategies, and high risk is not the problem by itself, because in finance, risk is what we deal with all the time. It's high risk, but negative net present value. So these are high risk investments that are value destroying, if you will. So CEOs are engaging in projects which in the short run look very attractive, generate lots of earnings cash flow, and maybe their compensation is tied to earnings, or maybe because of the high cash flow, the analyst thinks that these cash flows are sustainable down the road. The bank share price goes up. As the bank share price goes up, the CEOs unload a lot of stock, meaning they sell a lot of stock, which is what we are saying. The implication of this story is that if the incentive or the misaligned incentive compensation of the CEO that's creating these problems, then what you should see is the bank CEO and indeed other senior executives and directors, they should be selling a lot of the bank stock just prior to the crisis. So that's the very different implication from the good part. In the good part, it's normal amount of sales. In this bad or the ugly part of the story, where there's a problem with the incentive compensation of the bank managers, now you should be seeing very high levels of bank sales stock. So that's the sort of one key difference between our recommendations and what you see normally out there by other regulators and banking and bank academics. Data. It's always nice to look at some history and some number and some data. So these are bank CEO stock sales for that 2008 crisis. So the bars on the left, you're seeing the big green bars are the one for the too big to fail banks, essentially the 14 largest banks in the US at that time that were all close to failure, and they had to be bailed out with taxpayer dollars. So the average CEO in those 14 banks between 2000 and 2008, they sold $66 million worth of stock. Now, is that number large or small? Well, large or small always compared to something else. So here we are comparing the sales with that of other banks. Obviously, the other banks are somewhat smaller in size. So mid-sized banks, the next set of banks in size that did not ask for or receive any bailout funds, what at that time were referred to as the no TARP banks. The sales of those CEOs is in red, and that 1.2 million in the same period. So comparing 1.2 million to 66 million, you say, okay, the CEOs sold a lot. One common point that people will raise that, look, large banks, CEOs of large banks obviously own a lot of stock. So if they own a lot of stock, they'll sell a lot of stock. Fair point. So what we do is we divided their sales by the amount of stock the CEO held in the beginning of 2000. And now you're seeing a percentage. So for the large, too big to fail banks, their CEOs on average sold 60% of the stock they held as of January of 2000. Compared to the banks that did not ask for a bailout, their CEOs only sold 4% of their holdings. Now that's a very big difference, and that's what we're talking about, that back in 2008, the bank CEOs knew something. The too big to fail bank CEOs knew that the kind of trading strategies they were engaged in were not value creating in the long run, and hence when the share price was high in 06, 07, 08, they sold a lot of the stock. Okay, so what are we recommending here? So how do you address a problem like that? So we have what we refer to as a restricted equity proposal. And here the incentive compensation of the CEO can only consist of restricted stock and restricted stock options, the restrictions being such that they cannot sell the stock or exercise the option for at least 6 to 12 months after their last day in office. So what would that do? This would eliminate the CEO's incentive to focus on short-term earnings. So in the case of this Silicon Valley Bank thing, they sort of in the short run, if you take in a lot of deposits and invest them in long-term treasury bonds, yes, the interest rates that you're getting are very large, attractive, gets your earnings up, maybe the share price up, but you know that in the long run, if these demand depositors were to come and demand their deposits, there could be a problem, and the bank share price will go down. So if you focus the attention on the long run, then the CEOs of these banks are not likely to engage in these in these investment trading activities that in the short run look good, but in the long run are value destroying. Okay, so two points to note. One is, we are not advocating more regulation. So almost every other banking reform proposal is about let's have more regulation of some kind or another. The regulation that or the suggestions that we are making, they can be implemented. The proposals we are making can be implemented by the bank boards. The bank CEO's compensation is totally in the hands of the compensation committee of the board, and they can implement the compensation proposal which we just outlined. And then our other proposal on bank equity capital can also be implemented at the board level. The other point is that unlike other banking reform proposals, especially having to do with the CEO or bank executive compensation, a lot of observers out there and regulators and elected public leaders, political leaders, on both sides of the Atlantic, they would like to see smaller levels of compensation. Our proposal does not necessarily reduce the level of bank compensation, bank CEO compensation. In fact, if they are creating long-term value under our proposal, the CEO may well end up earning a lot more than they would have done in the earlier compensation regime. So let's look at the caveats. There are two caveats of our proposal. One is this under diversification. Being in finance, we are very sensitive about this issue of diversification. And those of you who may have talked to me earlier, if there's one thing we know in finance, there are not that many things we know for sure, but if there's one thing we know is that diversification works. And if you're going to have the bank CEO and the other senior executives and directors hold a lot of bank stock, they are clearly under diversified. But we know how to address diversification problems in finance. Basically, what that means is that if you give bank CEOs restricted stock worth 10 million, they may only value it at, say, 6 million. So the way you fix that problem is instead of giving them restricted stock worth 10 million, you give them restricted stock worth, say, 15 million. So, we are not trying to be punitive. Our focus is in getting the incentives right and addressing the caveats of under diversification that may come up. The other caveat has to do with liquidity. And to some extent, we are not persuaded it's a serious problem, but banks might say that, look, on paper, we have a high net worth. On the other hand, we don't have liquidity. One issue about liquidity, or there are 2 points. One is, if you look at the way that venture capital general partners, private equity general partners are compensated, most of their compensation comes at the tail end of their fund, which often has a life of 6 to 8 years. So, the compensation of some finance professionals who people that study this have found that investors in private equity venture capital have done very well. So maybe the incentive compensation there will align better. The other thing about liquidity is going back to that last slide that we looked at. So you're looking at the amount of stock sales of big bank CEOs back in 2008 as a proportion of the amount of stock they held in the beginning of 2000. And then compare that with, the sale of stock by the bank CEOs of the banks that did not ask for a bailout or did not receive a bailout. So you might say that, look, didn't the banks of these no-TARP banks, or the banks that did not ask for a bailout, didn't those bank CEOs also have liquidity needs? So if liquidity is what it's about, those red bars should be at about the same level as the green bars, and we don't quite see that. So it doesn't seem that liquidity is a real issue looking at actual empirical data. Okay, Now let's move on to looking at what's happening today with the stock sales of Silicon Valley Bank, First Republic. I mean, these are the CEO stock sales, Silicon Valley, First Republic, and Signature Bank. So in the last 2 years, the Silicon Valley Bank CEO sold almost $35 million worth. The First Republic around 23 million, and Signature Bank almost 20 million. Now, are those numbers high or low? Again, high or low has to be in the context of with respect to what. So I looked at this M&T Bank. M&T Bank has similar asset size as Silicon Valley. It's based in upstate New York, and it's not in any sort of financial distress. I calculated the CEO stock sales of the M&T Bank. That was a very small number. It was roughly around $2 million, actually less than 2 million. So, banks of similar size, their CEOs, some CEOs are selling a lot. And those are the banks we see in trouble, not just trouble. I mean, all of these three banks, two of them went bankrupt and one had to be rescued by a larger bank, or the forced merger. And there the CEOs sold a lot of stock before, of course, the crisis. But in the one bank that is still around and serving their customers, there's no signs of any financial distress with M&T Bank. Their CEO sold very little. So this is what we've been talking about, that if you have misaligned incentive compensation, you will get problems. So for whatever reason, the M&T Bank CEO's compensation structure, either implicitly or explicitly, has been structured the right way. All right. We've talked a lot about bank CEOs' compensation, but guess who sets the compensation of the bank CEO? Is set by the directors. So, one should also focus on the director's compensation. And we did a lot of analysis about director compensation. And what we are recommending. And while this conversation is about banks and bank, how to avoid the next banking crisis, the recommendation on director compensation applies for both the directors of banks and directors of non-financial institutions, meaning the directors of tech companies, manufacturing companies, retail, what have you. So again, over here, we are saying that all director incentive, for director, it's not just incentive, but we are saying all director compensation should consist only of restricted stock and restricted stock options. Now, there are some reasons to have exclusion from this, and we can get into that later. But why are we saying that? The easiest way to explain that is saying, let's look at the data. So here we are looking at the S&P Super Composite. So this includes, just banks, retail companies, tech companies, manufacturing companies, everybody, So, and the S&P Super Composite, they include the S&P 500, the largest companies in the US, the next mid-sized companies, and then the smaller companies. So you take this very large set of companies in the US, and you look at the director ownership, and so we're looking at the director ownership of the median director in each of these companies each year, and you put them in 4 buckets. So on your right side, you have the highest bucket. On the low side, you have the lowest. So on the high side, the directors owned $2.8 million worth of stock in their company. On the low side is $138,000. And then you look at the industry adjusted return on assets for the next 2 years. So you look at director holding, let's say in the year 2018, and then you look at their industry adjusted performance in years 2019 and 2020. Here our sample only goes to 2016, but you get the idea. So what this picture tells you, that in those companies where the bank directors have more skin in the game, or they own more stock in their companies, those companies do better in the years to come. So this is for all companies here, including banks. This chart is just for banks in the same time frame, 1998 to 2016. We looked at the 100 largest US financial institutions, same story. In those banks where the directors own more stock, they have more skin in the game, those banks do better. So that's why we are recommending that bank compensation or bank director compensation should also be consist solely of restricted stock and restricted stock options. Okay, now let's talk about bank capital. So far we've been talking about equity-based incentive programs, but these equity-based incentive programs, they lose their effectiveness in motivating managers and directors to enhance shareholder value as the bank's equity value approaches zero. So as the bank's stock price approaches zero, I mean, the value of the restricted stock option, all of these things start going towards zero. So the incentive effect starts to go away. And as that happens, then the managers have the incentive to take on very high risk, but value destroying investment projects. Because now they say, what do we have to lose? And we saw some of that behavior back in 2008, and we may have seen some of that this year also. So there are a very large number of bank capital proposals out there, and most of these proposals tend to get fairly complex. And we can talk about in what ways they are complex. And we think that the bank capital proposal needs to be simple, transparent, and then the whole purpose of the bank capital is to make sure that they create and sustain long-term shareholder value without any expectation of taxpayer-funded bailout. So these are the three criteria by which we want to recommend bank capital proposal. So what we are recommending here is that the ratio of tangible common equity, so equity value divided by total assets, and that should be at least 20%. And this number is a lot larger than what most banks have been used to, but we'll show you some data. Many of the prognosticators and many of the regulators are coming around to our viewpoint. But let me explain some things about the denominator. In the denominator, we are saying we want the total assets of the bank independent of the risk. What Basel and indeed our own FDIC and the Federal Reserve, what they're allowing is in the denominator, depending on what kind of assets the bank will have, they will have more or less weight. For example, in Europe, they said, well, sovereign debt is risk-free. So if a bank holds sovereign debt, it shouldn't really count as assets. Or if it counts as assets, it should count as less. If the bank holds, let's say, 100 billion of sovereign debt, maybe that should only count as 50 billion of assets. So if you decrease the denominator, the ratio goes up. Now that's a game that banks have been playing, and the regulators have been very happy to play along with this game. Now we keep saying that sovereign debt is risk-free. Think of Greece in 2012 and 2013. We say that sovereign debt is risk-free. In the US, sovereign debt, meaning treasury bond, treasury bills, are indeed risk-free if you hold them to maturity. But if the interest rates go up while you're holding the bonds, the treasury bonds, the price, the value of those bonds can go down. So anyways, so we are saying, forget trying to play these games about, risk weighted. We don't know what the risk is. Let's look at the total assets as it stands, no adjustment for any risk weight. And then we want to have both the balance sheet and the off-balance sheet item, because some of the banks have now spinning away what you call shadow banks, meaning shadow banks that are exactly like banks, except they're not regulated by anybody. So to not give these banks any incentives to create shadow banks out there, we say, let's take all of their on-balance sheet item, off-balance sheet item, put that in the denominator, and then make sure that this ratio is at least 20%. Okay, so 20%, how does that compare to where things are today? Silicon Valley Bank, just around 5%. First Republic, around 6%. Signature, a little bit higher, I think around 7%. Now, how did this M&T bank that is not in any financial distress, what's their equity to total capital? That's around 11% or 12% here. And our recommendation here is in green. Our recommendation obviously appears to be a lot larger than what these banks have. But the question is, what's the cost on the bank? What's the cost on the bank shareholders? What's the cost on the economy if these banks have more equity in their capital structure? If more of the bank is financed with equity as opposed to debt, what is the cost of that? Where is the problem? And we'll talk about some of this a little bit later in our presentation if we have time. But let's look at sort of the other benchmarks. So back in 2008, we showed you where the Silicon Valley Bank was recently, and Fourth Republic and Signature. The large banks in 2008 were actually below 5% in terms of their equity to total capital. Basel in 2011, after considerable study by their group of experts, they recommended a number between 8% to 9.5. And even this number 8 to 9.5 is after all these games have been played in the denominator to make the denominator smaller so you can get a higher number. Anyways, let's go with whatever number they're recommending. One of the Federal Reserve governors, he recommended a number like 14%. We came out with our first recommendation back in July of 2010. We wrote the first draft of our paper with a PhD student graduate from Leeds here. And I discussed that a lot in my book, that ratio. We were recommending a number like 20%. And then soon, a few months thereafter, for a very distinguished economist from Stanford University that happens to be right in the very backyard of Silicon Valley Bank, they were recommending a number between 20 to 30% of total capital. Ironically, if Silicon Valley Bank had listened to the advice of these distinguished economists in their own backyard at Stanford, I don't think Silicon Valley Bank would have had the kind of problems they've had today. In fact, they may very well be still very active and showing you these equity capital ratios to the overall economy. These numbers are a lot compared to where the overall economy is. Okay, so moving forward in time, so I told you back in 2011, Basel said that these equity to total assets should be between 8% to 9.5%. And of course, mind you, their ratio of total assets is a little bit gimmicky, but nonetheless, let's just go with it. In 2019, they came out with a sort of a study, a very carefully done study. It's a very thoughtful study. And that study concludes that the net benefits of higher capital requirements may have been understated in the original committee assessment. And in the study, they are saying that our recommendation is that banks should hold more equity capital. This time, they did not come up with a specific numerical recommendation, but they're at least saying that that number 8 to 9.5 was too low. Now they themselves are recommending a much higher number, but they don't specify what that higher number is. But they are saying that equity to total assets should be much higher. As it turns out, just this Monday, there's this article from Bloomberg, and they are coming out pretty openly now, that if the banking crisis offers one lesson, let it be this: more capital would make future disasters much less likely. And it's like I sort of don't want to say this, but I guess we have to say it. We've been saying this since July of 2010. This is not a new realization. We were applying standard corporate finance toolkits to banking and said, look, if you want to make banks more safe, just increase their equity capital ratio and get their incentive compensation right. And we will not have this problem every so many years. And finally, you have the distinguished regulators in the International Bank of International Settlements. They've come to the same conclusion: the banks need more equity capital. Bloomberg also now agrees with us that these banks need more capital. And there are other observers, including some of the Federal Reserve regulators, they're also saying banks need more capital. And I said, look, we've been saying this for a long time. This is not a new realization. Okay. So if bank capital, and I may have to move quickly here. So if bank capital, equity capital is such a good thing, why are banks, hesitant to increase the equity capital? And the bank CEOs are more likely their allies, and they have lots of allies in the media and amongst even regulators. So they will come up with what you call a parade of horrors as to how bad things can get if the banks were required to hold more equity capital. And they will have this parade of horrors, and none of their arguments have any rational economic content. We will just go through two of their arguments. I don't have the time to go to their laundry list of parade of horrors, but essentially none of the arguments make any economic sense. Let's start with one of their arguments that they talk about. Well, they say that, look, if you increase equity requirements, this will decrease the funds available for banks to lend. So what they're doing is they're confusing bank financial inputs. The bank financial inputs, like for all other companies, banks or non-banks, is equity and debt. And they're confusing that with bank products, which is one of the bank products is a loan. Think of this example. Consider the capital structure of an auto or a truck manufacturing company. They currently have 36% equity, 64% debt. Their product mix has 50% sedans, 20 SUVs, 30 trucks, and they produce some number of vehicles every month. Now let's think of a new capital structure, which is now 50-50. Does anybody in the audience think that this auto truck company is going to now have a different product mix of sedans and SUVs and trucks? Or if they will produce more or less vehicles than what they were doing earlier? When I've asked this question live, I mean, I've never seen any executive or any CEO or board member say, they will do anything differently. In fact, people often say, this is a pretty stupid question. Why would the company do anything different just because their bank capital ratio has changed? I said, well, there is the answer. Companies are not going to do anything different just because the capital ratio has changed. So if you increase the bank equity capital from 5 to 20, let's say, or from 10 to 20% of total assets, the bank is not going to do anything different. Another example that, or another of their parade of horrors that bank CEOs and their allies like to come up with, they say, look, if you increase the equity requirement, that will increase the bank's funding costs. And the argument is, look, since equity is a more expensive as a source of capital compared to debt, if you finance the bank with more equity and less debt, the cost of capital of the bank will go up. Well, as it turns out, from a theoretical perspective, and this is not a lightweight theoretical perspective, there are at least 2 Nobel Prizes that have been awarded to Merton Miller and Franco Modigliani on this proposition, that the cost of capital is not going to change depending on how much you finance the company with debt and equity to a first degree approximation. But enough of theory. Even in practice, when people have tried to measure the impact on the bank's cost of capital after there is a significant increase in the amount of equity capital, one authors find an increase of 3 basis points if you have a 10% increase in bank equity capital. Another set of authors find a number between 25 to 45 basis points. So that's the increase in the cost of capital. What's on the other side? This increase in the cost of capital should be viewed in the context of the cost that the 2008 crisis imposed on the economy. That's in the cost imposed on the economy was in trillions of dollars and millions of jobs. The cost of this 2023 crisis currently is $33 billion on the US taxpayers, while the fees that depositors pay when you deposit your money in any bank or credit union. So, the notion that if we increase the equity requirements, the cost of capital will go up, and hence we should not do that. There's very little empirical support for that, especially when you look at the other side of the coin, which means the cost they impose on the US taxpayers. So this gets us to our conclusion. And again, to highlight, we have sort of a two-prong recommendation. One is focusing on the bank CEO and director incentive compensation, all focused on long-term value creation. So it should only be restricted stock and restricted stock options. And the other prong of our proposal has to do with the bank equity to total assets. And that should be a much higher number than what most banks have. And that number we are recommending should be more than 20% of total assets. So with that, it's time for questions.
Professor Bhagat, thank you so much for your presentation. We got a lot of pre-submitted questions, and I'm going to run 6 over to you, to which you said have very similar answers. So someone asked, what, if any, additional regulatory oversight would have aided in preventing the bank collapse? Similarly, someone asked, what are your actions suggested to inhibit occurrences? And what could the First Republic Bank have done differently? Essentially, everyone is asking, can this happen again?
Yeah, so that sort of is like you noted 6 different questions. Maybe there are more questions like this amongst the, in the chat box or what you might have received. But the answer is the same. If you were to propose these, or if you were to ask these 6 questions to other bank regulators or bank reformers, they will come up with more and more complex bank capital regulation, bank regulation of one kind or another, focused on bank liquidity, bank capital. That's their modus operandi, is let's get more and more complex regulations. But there's no evidence that having more complex regulations have changed anything. We had Sarbanes-Oxley, then we had the big banking crisis of 2008. Then they came out after that with Dodd-Frank, which was a very extensive set of regulations on bank. And here we are back with 3 big bank failures, and the other regional banks are also appear to be in fairly deep trouble if you look at the stock market reactions today. So this goes back to the early part of our presentation today. In the 2008 crisis, the reformers focused on the fact that banks were holding very, very difficult to value assets. Today, they're talking about a duration mismatch. We don't know what the immediate problem is going to be for the next banking crisis. What we are trying to do is, you give the bank CEOs and the C-suite incentives to make sure that the banks don't get into trouble. So you give them incentive compatible contracts. So we don't know what the next problem is going to be, but what we can reasonably be sure, as the data on the CEO stock sales, bank CEO stock sales shows, that the CEOs get a sense when things are not going right, and they get that sense years before things actually blow up in the markets. So if you give them the incentive to focus on the long run, these CEOs are smart people, and either they have the technical wherewithal to do the right thing, or they can go out and hire consultants or to get the right thing done. In the case of Silicon Valley Bank, it would have been fairly easy to do an interest rate hedge, or there are other ways of avoiding this duration mismatch. That's really not a very, very, very difficult problem to handle. But what we are saying is, duration mismatch is the problem for this time around. Next time it may be something else. Whatever that something else is can be addressed much better if you keep the CEO's incentives focused on the long term. But along with the CEO's incentives, we are providing a backup plan that, the bank's equity is at a much higher level. So if a bank has significantly more equity than they used to, then this equity will act as a buffer if something really unexpected happens. Thank you.
Thank you very much. I'll ask our next question here from our live audience. If non-bank corporate balance sheets, equity can be noisy given the one-time items and the share repos, some strong credits that have negative equity. Do you think this is an issue with banks? And how does your equity cap recommendation account for this?
Yeah, excellent question. So in our equity capital recommendation, we're saying total equity, tangible equity. So we are going off the balance sheet items, and the actual market value of the equity can depart a lot from the balance sheets. So the volatility in the stock market, can make if you use the numerator as the market value of the equity, that can be a lot, the sort of ratio can be very much more volatile. Most of what we've done with our empirical data, and we saw that today, even with Silicon Valley Bank, Signature, First Republic, and then the M&T Bank, that even if you were to look at the balance sheet value of the total equity divided by total assets, that number can be a fairly good, good proxy for trying to keep the bank on the safe side, but just make sure that number, the denominator doesn't get played around with. We just use the total assets and keep that number around 20% or even higher.
Thank you very much. And Professor Bhagat, do you think this crisis is over? And if not, what should we be watching for?
I think if you look at the stock market today, especially with regard to the regional banks, it appears that the crisis is not over. I think other banks, regional banks also have these demand deposits that they may have invested in long term. Now, one can look at their balance sheets and get some sense, and I imagine stockholders or stock analysts have been doing that. And then, of course, a lot of the deposits are being moved to the too big to fail banks, the very largest 8 banks in the country. So those largest 8 banks, though officially they are not too big to fail, everybody thinks they're too big to fail, meaning they will get bailed out by the US taxpayer. So if you're saying, are these banks in trouble? No. Are the US taxpayers in trouble with regard to this banking crisis? I think the answer is yes.
Thank you very much. Our next question comes from the audience again. What will happen to bank stop ROE if the proposed increased equity to assets ratio is instituted?
Yeah, so that's one of the reasons why bank CEOs want very low levels of equity. So if you have a smaller amount of equity and given the same level of total assets, for some return on assets, you'll get a much higher return on equity. So that's just a mechanical, relationship. I think in most of the people in the audience who've had a finance class, they probably did that if you increase the leverage, for some given return on assets, you get a much higher return on equity. That's the effect of leverage. But the question is, why should we be focused on return on equity? Some misaligned CEO compensation for some banks were focused on return on equity, and that's basically a very misaligned incentive compensation plan that the bank should never have, that the bank's compensation committee should never have proposed. So there was the first mistake. Yes, the return on equity will go down if the bank equity capital goes up. But the question is, so what? We should be focusing on return on assets, not return on equity. In fact, we should be focusing on long-term shareholder value. So yeah, the point is that the return on equity will go down, but so what about it?
Thank you very much. Our next question is a pre-submitted one that asks about the need to reform risk-based capital rules. Can you summarize?
Yeah, so I touched on that, so when we're talking about bank equity capital, in the numerator, we had equity capital, denominator, we had total assets. And the total assets, should be fairly straightforward from the balance sheet. But what many regulators are allowing the banks to do, and of course the banks are more than happy to do, is saying, look, not all assets are the same. Some assets are very safe. So these total assets should be risk adjusted. So if you're holding sovereign bonds are very close to being risk-free. So if you're holding the example I gave, if you're holding $100 billion worth of sovereign bonds, maybe they should count only at 50 billion of assets. So that will decrease the denominator. If you decrease the denominator, the ratio goes up. So the equity capital ratio looks attractive and maybe higher than what some regulator has or some regulation has noted as the minimum benchmark. So by incorporating these risk-adjusted assets in the denominator, it allows the bank CFOs and CEOs and working, to satisfy the bank regulators, and the bank regulators are happy that whatever minimum equity capital ratio they have, these banks that under their supervision are meeting, and everybody is going happily along until something like 2008 crisis blows up, or in this case, the 2023 Silicon Valley Bank, Signature Bank, First Republic crisis blows up, and then the U.S. taxpayers are on the hook for the tune of $33 billion and counting. So all of these games, look good on paper. Keeps everybody, meaning the bank CEO, CFO, regulators happy. But these are just games. Ultimately, at some point, what cannot go on forever usually does not. And when things unravel, ultimately, all of these things, it's ultimately the U.S. taxpayers that have to bear the brunt of it.
Thank you very much. I will close us off here with one last question. As a consumer, how can I know if my bank is not being managed well and may be close to failure?
So I guess most people, typically don't have deposits more than $250,000 in a bank. So if the amount of deposits you have are $150,000 or less, you don't have to worry about it. The amount is insured by the FDIC, and if the bank fails, the FDIC has money in the insurance pool to basically make you whole. If you have more than $250,000, you shouldn't be investing it in, you shouldn't be putting it in a bank to begin with. Those additional dollars should be going into some sort of a investment account that will hopefully pay you or get you much higher return. So you shouldn't even be thinking about having more than 250,000 in a bank.
Thank you very much. And thank you so much, everyone, for joining us today for today's presentation. And thank you again to Sanjai for this great information. At this time, we invite you to provide your feedback on the webinar by answering the following poll question. On a scale of 1 to 10, how likely are you to recommend this webinar to a friend or fellow Leeds alumni? We thank you in advance for submitting your feedback. As a reminder, all webinar attendees will receive an email tomorrow with a link to the recording of this presentation, as well as a survey. To view upcoming webinars, as well as previous recordings, please visit our website at www.colorado.edu/business/alumni. We look forward to your next professional development webinar, which will be in the next quarter. In the meantime, have a great rest of your day. Thank you for your time, and go Buffs!